So let's start with the next section, that is leverage. Leverage. What do you mean by leverage, by the way? What is the first thing that comes to your mind when you hear a word called leverage? Leverage. Anything that comes to your mind. The first word the first thing that comes to your mind when you hear this word called leverage. Any idea?
Risk.
Risk. Okay. The first thing that comes to my mind with leverage, which is also called as gearing, lever or gear. Where are these words generally found? Lever and gear. Did you hear these words first in finance? I don't think so. Tell me, where did you first hear these words called lever or gear?
In cost of capital, we just
No.
adjusted.
No. The first time you must have heard this is while driving a car. Lever or gear. Haven't you? Of course, if you've been driving automatic cars, you may not be aware about the gears. But of course, you know what are gears. Gears in car or lever in car. Correct? Have you heard about it?
Yes.
In the auto industry, we use these words very frequently, cars and gears and lever. What's the use of it? What happens when you gear, when you put the car from first gear to the second gear to the third gear into the fourth gear? What happens?
It increases the speed.
It increases the speed, right? So when you go from first, second, third, fourth, it increases the speed. So it either helps you reach faster to the destination like this, if you control, and if you don't control, it helps you reach faster to this destination. Correct?
Yes.
So it is a double-edged sword. Same is with leverage. Leverage means risk in business. When you increase the risk in business, let's say by having more debt, which is a financial risk. So if you have more risk in the business, if you have more debt, leverage helps you reach faster to your goals. It helps you to expand faster. But if you can control, if you can't control, it will help you. It will also be a disastrous thing for you, right? So the impact of lever or gear in cars or leverage or gearing in business is the same. Therefore, they are related. And that's the reason why we use that word in finance called leverage or gearing. Whenever we say leverage or gearing, it means that increasing risk in the business. Okay, everyone clear? Leverage means basically risk. Is risk a bad thing? No, unless and until you know how to play with it. Fire is not a bad thing unless and until you know how to use it, right? So leverage in finance, especially when it refers to the companies using leverage, it means the amount of fixed cost a firm has to pay, or the amount of fixed cost in its capital structure, or the amount of fixed cost in its operating structure. First of all, tell me, what are the fixed costs in your business? There are two major fixed costs in your business. One is called fixed operating cost and another is called fixed financing cost. What is fixed operating cost? For example, let's say I run educational institute. Okay. So I take lectures at various places. Now, let's say I have a batch coming up in one of the cities, and that batch is for 100 hours, right? Now, I don't know whether I'll get continuously more batches there. What do you recommend me? Should I take a place on lease there for 1 year? Or should I go with the another option where I get the place for hourly rentals? So if I take the batch for 10 hours, I just have to pay for 10 hours. Of course, that is costly, but what do you recommend me? Should I take lease a class for a classroom for entire 1 year? Or should I just take the class on an hourly basis? What would you recommend me? I'll take your suggestions. What do you recommend me? It's a new city. It's a new market. What do you think? What should I do? Should I book a class for the entire 1 year and pay the fixed rent? Or should I just pay
Hourly,
it on a variable basis where I just pay it on a
variable basis.
variable basis? Everyone agrees with this. Anyone else has anything else to suggest? Divesh, what do you think? Should I take the class on a fixed rental or on a variable basis?
Variable.
Variable. So you all both have the same answer. Everyone has probably the same opinion. Can you tell me why specifically? Any one of you? Can you specifically tell me the reason why?
Because you might not need it for a year.
I might not need it for the year. That is one thing. Anything else? What is the main thing going behind your mind? What if it doesn't work? Then your entire yearly rent is gone.
Yes.
Correct?
Yes.
And even if it works, let's say my yearly rental is $50,000. So even if my business works, even if I'm not sure whether, how much it will work, but if, let's say, even if the business works, till I make the fees of $50,000, I won't be able to make profits, right?
Yes.
What if the total profit I'm expecting is only $40,000? Then should I book the class on a fixed rental of 50,000? No, it doesn't make sense, right? So what the answer that you said is, what is more riskier? Having fixed cost in your business is more riskier, or having variable cost in your business is more riskier, especially at the start of the phase of your business?
Fixed cost.
Fixed cost is more riskier, correct? That's the
Yes.
reason why when we start business, if it's a new business, if it's a new place, if it's a new venture, if it's a new market, then you don't make lavish investments in the office and interior and everything. Correct? You initially take the place on rent and see how the business is going. And then when you realize that the business is stable out here, you're going to get enough clients, then you start bootstrapping and investing in the office infrastructure. Correct? Till that time, you just lease it. Or these days, you have options like WeWork, where you can just share the office space, isn't it? So, which is the more riskier thing in the business, to employ fixed cost or to employ variable cost?
To employ fixed cost.
To employ fixed cost. So fixed operating costs and fixed financing cost are the two costs in the business which increases your risk. Fixed operating cost can be building or equipments, right, which you have taken on lease, or as I give you an example, that I've taken the property on lease for, let's say, 5 years or 2 years, and I've paid the lease upfront. So now I have to just wait and watch. What if the customers don't turn up? My lease is still gone. And then you have fixed financing cost. What is fixed financing cost? What is one capital that you have to compulsorily pay? Is it debt or equity?
Debt.
Under debt, you have to compulsorily pay the interest, right? But in equity, you don't have to pay. I know that in equity, you have to give away your stake, but I don't have a fixed liability to pay. I don't have the pressure to repay back. Are you getting my point? So when it comes to operation, we focus on fixed operating cost. When it comes to financing, we focus on fixed financing cost, that is debt. Is that clear? Right? And remember, the more and more you have fixed structure in your business, whether operating or financing, the risk of the company will increase or decrease? The risk of your company,
Increase.
the risk of the company will increase. Correct? That's what leverage is. Leverage is risk. Higher the leverage you have in your business, more riskier will be your business. So basically, when we do business, there are various types of risk. The most primary risk that people face is the risk of revenue, whether you will get the revenue or not, whether you will be able to make the sales or not. Correct? Is the revenue risk in your control? Tell me one thing. Is the revenue risk, whether I will get the business or not, is that completely in my control?
No.
Well, that's not completely in my control, because that depends on business environment, that depends on the demand, supply, and various other macroeconomic or broader factors. Correct? That depends on the market, the industry, and everything. For example, even if I have one of the best business models now, but in this era of pandemic that we have seen, if your businesses are very lucrative businesses, you have like a restaurant chain, a fast food chain where people sit and dine, that's not going to work in this pandemic, right? In this pandemic, more of things are going to work where you're going to deliver the goods. So pickup orders will be more useful now than ever before. So all those people who have invested heavily in infrastructure and in the restaurant business, they are facing severe crisis, correct? Those who have put a lot of money by borrowing and putting a lot of fixed cost, they are right now at a very, very risky model, isn't it? But what about the startups? Do you think startups invest heavily in infra and all? No, they generally work on a shared space, or they work on a short-term lease agreements and all, correct? So a lean model here helps in the crisis. But if you have heavily invested, that's a very risky thing. So sales risk is the risk, revenue risk is the risk that is something that is out of our control. But the operational and financial risk are your decisions. How you want to do the operations? Do you want to have more fixed cost or more variable cost? How you want to manage your finances? Do you want to have more of debt or equity? That is something that you need to manage. And so if I'm comparing two companies, can I say the sales risk will be same for both the companies? The market risk will be same for both the companies, right?
Yes.
So what will be the difference in their profits due to? The difference in their net income will be due to how they manage the fixed operating cost and fixed financing cost. Are you getting it? So the difference between both companies will be due to how they manage the fixed operating cost and fixed financing cost. When it comes to operational cost, you have fixed and variable. Fixed and variable. But when it comes to finance, what is the fixed financing cost, guys? Debt or equity? Debt. Correct. So we are going to focus on, our entire focus in the topic of leverage will be on the risk in the business, and that is the fixed operating cost and fixed financing cost. That's going to be our risk. Now, how do I know what is the fixed cost and what is the variable cost in the business? A normal income statement looks like this. Everyone with me? Sales minus cost of goods sold, you have which profit? Gross profit. Then you subtract the operating expenses, you get operating profit, EBIT, then interest, then EBT minus tax, and then you have net income. That's the flow of income statement, correct? Everyone? Now, the another way to see the income statement is through the costing approach. Through the costing approach, where everything else is same. What is going to be the difference? If everything else is same, all the costs, where are all the costs? In COGS, cost of goods sold and operating expenses. All the costs before the operating profit, all the costs are separated in two parts. Which two parts?
Fixed and variables.
Fixed and variable, correct. So variable cost, what do you mean by variable cost? These are costs which are directly related to sales. Okay. For example, I can say the printing cost. The printing cost, let's say I have 100 students and I have to give them one print. Okay, one paper print. So my cost of printing depends on the number of students that I have. Right? That's a variable cost. But the cost of infrastructure that I have already built, whether I have one student or 100 students, that's a fixed cost. So between sales and operating profit, we are now going to input the fixed and variable cost. But the cost which is directly related to revenue or sales is which cost? Fixed or variable?
Variable.
Variable, as the name says. So when I subtract the variable cost from the sales, we get a new term that is what we call as contribution margin. Contribution margin, or simply you can say contribution. So what is contribution, guys? Sales minus the variable cost is contribution. Everyone. So even if the quantity is same, even let's say you have sold 100 quantity, your sales and variable cost, let's say your selling price is $5 per unit and your variable cost is $3 per unit. So your contribution is $2 per unit. Is that clear? Everyone with me? So if the sales increase or decrease by 10%, what will happen to the variable cost? If the sales increase or decrease, let's say by 10%, what happens to the variable cost?
Same effect. So increase or decrease by
The
10%.
variable cost will also change by the same percentage. Is that clear, everyone? Right? So the variable cost will change in tandem with the revenue. So all the costs I've separated into variable cost, and from the contribution, I will subtract the fixed cost. Everyone with me? And that fixed cost is going to be fixed for irrespective whatever the quantity. Let's say I sell $100 good, 100 quantity of goods or 5,000 quantity of goods. We assume that this fixed cost is going to be constant. So what we've done is that between the revenue and the operating profit, all the costs are now subtracted into variable and fixed cost. Everyone clear with me? Clear with this point? Everyone?
Yes.
Right? So let's focus on the leverage. And for leverage now, again, we will quickly do the revision of the income statement. So now you'll have revenue. Then after that, you have variable costs, which are in line with the revenue, which is called as contribution or contribution margin. Less fixed cost, then you have operating profit, and then everything else is in interest, profit before tax, then tax, then net income. And from net income, if you have preference dividend, you first pay them, then you have earnings available for equity shareholders. If you divide that by the number of shares outstanding, then you get earnings per share. Is that clear? Everyone clear with the flow of income?
Yes.
We've already covered that in FRA. Now, how do I calculate the operating, financial, and the leverage, which is a combination of both, is called total leverage. First of all, what are the two types of risk that we were discussing? Operational risk and financial risk. Operational risk is due to what exactly? Due to the fixed cost or variable cost?
Fixed cost.
Variable.
Due to the fixed cost. Variable cost is not risk, because variable will change with revenue. If there is no revenue, you don't have to pay any cost. The more the amount of fixed cost in your business, the more is your operating leverage. And the more the amount of debt in your capital structure, the more is called the financial leverage. So there are two types of leverage, operating and financial leverage. However, you may see a column here, the third, total leverage, which is nothing but a combination of operating and financial. So let's focus on operating and financing leverage only. Operating leverage is due to fixed operating cost. Am I getting?
Yes.
Everyone? And financial leverage is due to the fixed financing cost, which is interest. Is that clear? Okay.
Yes.
Now I'm not getting into the formula now. I'll show you the formula so that you will remember it very easily. But just let me tell you that the combination of both operating and financial leverage together becomes something that we call as combined leverage or total leverage. So what is total leverage? It is a risk due to both the fixed operating cost and the fixed financing cost. Clear? So basically there are how many types of leverage? 2 or 3?
3.
2.
There are only 2 leverage, and the combination of both is the third one, by the way. So it's only operating leverage and financial leverage, and the combination of both is total leverage. Clear? Now I will take you to the example where this one example will cover everything about leverage. By the way, there are 2 types of formula for leverage. One is called a static formula and another is called a dynamic formula. Now, to make you understand both the formulas, I will actually first take you to the example, and from that we will try to understand the formula so that you don't have to memorize it. So we'll first focus on the static formula, and then we will see how the dynamic formula helps us. So for the next 20-30 minutes, do have patience and do with me. Only then you'll understand all these formulas. Otherwise, it will be difficult for you to remember. So let me take you to a proper example where we will calculate everything. Okay. So here is the example. You have quantity of goods as 1,000 units. Selling price per unit is $100. Variable cost is 60. Fixed cost is 200,000. Interest expense is 5,000. and the number of shares outstanding are 1000. So there are two companies. I have been given company A's data, and you can probably have company B, C, and various other companies. If I were to just focus, sorry, I've done by mistake B here. If I were to just focus for company A's, the numbers that I've given, let's find the revenue. What is going to be the revenue here, guys? I have 1000 units.
100.
1000 into 100.
So
Okay.
I will put, this is going to be 1000 into 100. So this is going to be 100,000, correct? Variable cost is going to be 1000 into 60. So that's going to be 60,000. So basically my contribution will be 1000 into 40. My contribution will be 40,000. Am I correct? Everyone? Now comes the operating risk, which is fixed cost. How much is the fixed cost? That is 200. So fixed cost is 20,000. Sorry, it's not 200, it's 20,000. So if I subtract 20,000 from this, if I subtract 20,000, how much will be my operating profit? My operating profit, guys, here will be, my operating profit here will be 20,000. From that, they've given me interest of 5,000. So I will subtract 5,000. So my earnings before tax in this case will be 15,000. Since they've not given any tax rate, I am ignoring the tax rate. So this is going to be my net income as well. And if I divide that by the number of shares, let's say 1000, my earnings per share will be 15. Is that correct, everyone?
Yes.
Clear? Everyone clear with the flow?
Yes, sir.
Yes.
Now, what is the reason behind operating leverage? Operating leverage is due to?
Operating expenses.
Operating leverage is due to
Fixed overheads.
fixed operating cost.
Fixed operating.
How much is that here? 20,000, right? So how do I find the operating leverage? Well, in order to find the operating leverage, where is operating leverage? 20,000 here, right? Fixed cost. The easiest way to remember the formula is just take the things above and below that. What is the thing above fixed cost that you have here? Contribution. And what is the thing below the below fixed cost?
EBIT.
EBIT. Everyone with me? So when you take contribution divided by EBIT, which is in this case, how much contribution divided by EBIT? If I take contribution, which is 40,000 divided by the EBIT, which is 20,000, I get an answer of 2. So my operating leverage is 2. What is the technique I told you guys? The leverage that you're finding, just take the figure above and below that. That's the easiest way to remember. Okay, I'll have to blend the technique and the logic both. So just have patience for a while, but just see how the technique will work. How much is the what is the financial leverage due to? The financial leverage is due to the fixed financing cost is interest. So what is an item before and after the interest? Just take that. What is the item before interest?
EBIT.
EBIT. And if you divide EBIT with the item below interest, that is EBT. Correct? Earnings before tax.
Yes.
So when you take EBIT, you have 20,000 and you take EBT, which is 15,000. So you'll get 1.33. Is that clear, everyone?
Yes.
Everyone? And now total leverage is due to fixed cost and interest, both, right? So take the item before fixed cost. Contribution, and take the item after interest, which is EBT. Are you getting it? So if you take 40,000 divide by 15,000, you'll get 2.67. Everyone with me on this first?
Yes.
Yes.
Yes. And if you notice here, what you have noticed, that total leverage is nothing but a combination of fixed and operating. So just see, I'm sure you must have noticed So my degree of total leverage is nothing but degree of operating leverage, multiply that with degree of financial leverage. Just see that. Degree of operating leverage multiply with degree of financial leverage. For example, what is degree of total leverage formula? Contribution over EBT, which is nothing but contribution over EBIT multiplied with EBIT over EBT. If you see this, this will give you nothing but contribution over EBT. Clear? Therefore, if you multiply both, that is 2 into 1.3333 recurring, you will get 2.67. Are you getting it, everyone?
Yes, sir.
Yes.
So, degree of operating leverage is due to
Fixed expense.
fixed cost.
Fixed cost.
Degree of financial leverage is due to interest, and degree of total leverage is due to both. Now, the more and more you have this fixed costs, the more will be your leverage or the less will be your leverage? The more and more fixed cost you have, your leverage will be more or less?
More.
More.
The leverage will be more. What if you don't have fixed cost? Let's say, what if you don't have fixed cost here? Then contribution over EBIT will be 1. So when there is no leverage, what is the leverage ratio?
1.
1. It's not 0, okay? It's 1. Similarly, if you don't have any interest, let's say you don't have debt in your company, so there will be no interest. So then your financial leverage ratio will be 1. Are you getting it?
Yes, sir.
Clear, everyone? So now see the formulas here. What is the static formula of degree of operating leverage? It is due to fixed cost, right? So remember it in the income statement. What is the item before and after fixed cost?
Contribution.
Contribution and
over
operating.
EBIT. Contribution over EBIT. That's the static formula for operating leverage. For financial leverage, which is due to interest, and the item before and after that is EBIT over EBT. So you can say EBIT over EBT. And total leverage is due to both. So you will take contribution over EBT, because between that contribution and EBT, you will have fixed operating cost and fixed financing cost both. Is the static formula clear to all? Logically and technically. Is it clear, everyone?
Yes.
Yes.
So the conclusion is, the more the company has fixed operating or financing cost, the more will be its leverage. But if the company has no leverage, it means the ratio will be 1, right? Because then the contribution and EBT or EBIT will be same if there is no leverage. Is that clear, everyone? Okay. Anyone, any doubts till this point? We are not done with the example also, neither with the formula. We are yet to do the dynamic formula. But till this point, everyone clear?
Yes.
So if you're comparing two companies, right? If both the companies have same net income, that's just the returns, right? We always compare companies not only on the basis of return, but also on the basis of do you think only returns when you invest in the companies, or you also think something else?
Operating margins.
You see the risk,
Yes.
and that risk here is leverage. So if both the companies are giving you same net income, you will also see which company is highly levered or highly leveraged. Got my point? And that's what you will calculate. So based on the operating or financial or total leverage, then you will also see the risk parameter of the company. Is that clear, everyone? Correct. Till this point, everyone clear? Any doubts, please let me know. Anyone? Any doubts with the formula? Yes, no?
No.
No? Okay. So tell me one thing, and now I will need your help and your contribution also. Tell me one thing. What is the operating leverage due to? The operating leverage is due to
Fixed cost.
fixed operating cost. Now, just don't say fixed cost, but fixed operating cost.
Fixed
However,
operating
in the
cost.
income statement, we just write fixed cost, but that is ideally fixed operating cost.
Fixed operating cost.
Correct. So the operating leverage is due to fixed operating cost. So what is the static formula? The static formula, think logically. It is what is the item before fixed cost and after fixed cost.
Contribution upon EBIT.
Over EBIT. Clear? Now that is the static formula. If I have to find the dynamic formula is more like elasticity or beta, where they tell you the change in something due to something. So the dynamic formula will tell you the percentage change in something due to something. Okay, we will see that what it is. In the same way, can you tell me the degree of financial leverage? It is due to fixed financing cost, that is interest. So what is an item before and after?
EBIT over EBT.
Very good. EBIT over EBT. So same way, the dynamic formula will be percentage change in something due to something. Okay, we'll see that. And finally, degree of total leverage is due to both. So it will be contribution over EBT. So degree of total leverage is percentage change in something over something. Now, whenever you see percentage change in something due to something, most of the times they give you they give you the leverage, or they give you the data and the percentage change in either of the things, so that you can find the percentage change in other things. For example, what if you have beta of a stock? What is beta, by the way? Change in stock due to
Sensitivity, like due to the change in the market.
So what if I have the beta of the stock as 2 and I just need change in one of the things so that I can find the change in other thing, right? So if let's say the market falls by 10%. So what I will do, I will get change in stock is beta into percentage change in market. So 2 into, let's say market falls by 10%. So I'll get the change in the stock by 20%. So the stock will fall by 20%. This is how we use it, right? Correct?
Yes, sir.
Now let me erase this. So what are we going to do with this? With this degree of leverage, the static formula which you have already got, you will use it in the dynamic formula. This degree of leverage from the income statement that you get, you will use that in the dynamic formula, and then they will give you one of the percentage changes here so that you can find a change in the other things. Correct? So now the focus will be, what is the degree of operating leverage? It is change in something due to something. First of all, tell me, what is the change going to be due to? The change in operating leverage is going to be due to fixed cost, isn't it? Everyone. Am I correct? It is going to be due to the fixed operating cost. Clear? So the formula of degree of operating leverage, and see this carefully, is percentage change in EBIT over the percentage change in contribution or sales. Why? Because the change in sales, variable and contribution is going to be the same. Guys, if the sales change by 10%, the variable cost will also change by same rate, and the contribution will also change by the same rate. Am I correct?
Yes.
So the change in the percentage change in sales, variable and contribution is always same. Is that clear first?
Yes.
Percentage change in all of these is always going to be same. So whether they say change in contribution or change in sales doesn't matter. So guys, here, what is degree of operating leverage dynamic formula? It is change in EBIT due to change in sales. Now, many of my students, they remember it as the reverse of the static formula, which is also not a bad technique to remember. So if you know the static formula, the dynamic is the percentage change reverse. Are you getting it? So in the same, using the same technique, can you tell me what is going to be the degree of financial leverage using the same technique?
EBT upon EBI.
Percentage change in
EBT.
EBT.
EBT over percentage change in EBIT. Correct? Everyone? And degree of total leverage, I will say the reverse, you can do it. That is percentage change in EBT divided by percentage change in contribution. Is that clear, everyone? Yes or no?
Yes, sir.
Yes.
Now, assume that there is no tax. If there is no tax, can I say EBT, net income will be the same thing? So EBT or net income will be the same thing, right? So instead of EBT, they can also give you net income or EPS. Net income or EPS. Like if they give you for contribution or sales. When there is no tax rate given. Okay. So here they don't want to inculcate tax and make it complicated. So most of the cases they will not give you a tax rate here. If they give you, then it's not the same. But if they don't give you, then guys, the change in EBT or net income is same. Is that clear?
Yes, sir.
So we have got already the formula of the static formulas here, right? And the static formula that we have, and now along with that we have the static we have the entire income statement in the static formula. So I'll quickly write here, for this company A, we had 100,000 as the revenue, we had 60,000 as the variable cost, our contribution margin was 40,000, our fixed cost was 20,000. Correct? Fixed cost is minus, by the way, so you can simply just put the signs here. And my operating profit based on this was 20,000. My interest expense was given to me was 5,000. So my EBT or net income in this case is 15,000 because there was no tax. Number of shares were 1,000 and therefore my EPS was 15. My degree of operating leverage I got was 2.22. Here it was 1.33 and here it was 2.6667, or you can simply say 2.67. No issues. You can round it off. So they have said me in part B, calculate the leverages now using the dynamic. So they have told me the change in EBIT if the revenue goes up by 10%. By the way, can you tell me which dynamic formula takes into account the change in EBIT and revenue? Now, instead of revenue, you can also say contribution. Which formula?
Operating leverage.
Operating, financial, or total?
Operating.
Operating. So can you tell me what is the formula of degree of operating leverage, dynamic one?
Percentage change in EBIT upon percentage change in
Percentage change in EBIT.
Percentage change. I will write here percentage change in EBIT over percentage change in either you can say contribution or revenue, whatever they say. Correct, everyone? So guys, here I will put the percentage change. How much is the percentage change in EBIT? Have they given me percentage change? No. So I will write percentage change in EBIT. I don't know. So percentage change in EBIT, I don't know. But they've given me change in revenue. What is the change in revenue, guys? 10%. It goes up by 10%. So I will write plus 10%. Am I correct? And this should be equal to how much? To the degree of operating leverage. We have already calculated. What is the degree of operating leverage, guys? 2. We have already got the degree of operating leverage from the static 2, right? Everyone? Clear? So now, if I want to find directly the change in EBIT, can I find that with applying simple mathematics here? What will I do? 2 into the change in revenue, that is 10%. So guys, how much will be my change in EBIT? It is going to be 20%. Am I correct, everyone? Will it be increase or decrease?
Increase.
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 So can you tell me what will be my new EBIT? Initially, how much was the EBIT here, guys? 20,000. So it will increase by 20%. So I will do, how will I calculate this? 20,000 multiplied by 1.2. So my new EBIT will be 24,000. Everyone with me on this? Is that clear?
Yes, sir.
Let's verify this. How much did your revenue go up by 10%? So can I say instead of 100,000, I will take 110,000? My variable cost will also go up by 10%. So this will become 66,000. And my contribution will also be now 10% up. Am I clear?
44,000.
But the fixed cost will remain fixed. So my EBIT now becomes 24,000. We got the same answer, right? Everyone here? Clear, everyone? Anyone has any questions? Everyone? So we just verified it. Everyone. So if you have the static answer and if you put that into the dynamic, you don't have to again draw the income statement. You can directly give the answer. That if the revenue changes by 10%, how much will the operating profit change? If you have the degree of operating leverage, you can directly give the answer. It will change twice. It's like having a beta of 2. So 20% will be the change. Got it, everyone? Make sense?
Yes, sir.
Should I move to the part B?
Yes.
Yes.
Part B. They have said change in EBT or EPS if the EBIT falls by 15%. So guys, EBIT and EBT, they've given me the change in EBIT and EBT. What formula does it give me? Like, what is this basically? Change in EBIT and EBT. Which formula gives me that?
Financial leverage.
Financial leverage. Where we take the change in EBT or EPS, EBT or EPS, divide by the change in EBIT. Is that clear, everyone? So now I will take the change in EBT or EPS, and what they have told me that EBIT falls by 15%. So now I will take this as negative 15%. And that should be equal to financial leverage. What was my financial leverage, guys?
1.33.
1.3333. So you can take 1.3333. You can take exact figure also. Okay, no problem. So my percentage change in EBT or EPS will be 1.3333 multiply with 15%. But remember, guys, this is negative. So my answer will be 20%. Am I getting 20%? Just verify that.
19.95.
Sorry?
19.95.
Okay, if you take just 1.33, if you take 4 recurring, you will get rounded off 20% negative. Correct? So my new EPS or EBT, just let's directly take EPS. What should be my new EPS, guys, here? What was my previous EPS? 15. Correct? So my new EPS will be 15. I will do what? 15 less 20%. So I can multiply that with 0.8. Am I correct? So my new EPS should be 12 due to the fall in EBIT. Is that clear, everyone?
Yes.
Let's verify that. Let's verify that, everyone. So if we put that into the income statement, what changed? EBIT fell by 15%. So my EBIT was 20,000. Can you subtract 15% from 20,000, guys?
17,000.
17,000 minus the interest, that is 5,000. So here you get 12,000 as net income. 12,000, correct? So your number of share is 1,000 and your EPS is 12. That's the answer we had, right, everyone? Clear? Everyone with me on this? So the important thing is that you should know which dynamic formula applies here. So now you don't have to draw the income statement. You can directly give the answer. The income statement that you see here is what I'm just drawing it for your verification. This is just for verification. You don't have to do it in exam. So don't get worried with everything that I do. I'm just telling you how, if I manually plot in the income statement, I'll still get the same answer. Everyone. Everything I'm comparing it from the base. This is the base here or the base point. Everyone. Anyone? Any doubts till this point? Can you do the last one for me, part C? Can you try that? They've asked change in EBT or EPS if the revenue increases by 30%. Which formula will you apply? Change in EPS and revenue. Can anyone tell me?
Total.
Total. See, this will help you so much in real life that if someone tells you if the revenue is going to change by X percentage, how much exactly is going to the EPS change? You don't have to again draw the entire income statement. You can directly give the answer by just looking at the total leverage. So total leverage is change in EBT and EPS divided by change in revenue. So revenue they have said is increases by 30%. So my total leverage was 2.6667. I'm getting a change as 80%. Let me know if I'm correct or incorrect.
Correct.
80%. So
Yes.
my EPS at the base year, my EPS was 15. Now it will increase by 80%. So I'll do 1.8. So it will become 27. I hope that is correct. So let's see a change in revenue by 30%. So from 100,000, it will become 130,000. This will become from 60,000, 30%. It will be 78,000. 40,000 to 30%, 12. So it will be 52,000. Fixed cost will remain the same, 20,000. So my EBIT will be 32,000. My interest will also remain constant. So here it will be 27,000, which is my EBT. Number of shares, I'll get my EPS as 27. Verified. Is that clear, everyone?
Yes, sir.
Everyone getting the understanding of how to take the dynamic and static and use it? So this one example covers everything. So first calculate the static formula, then use the dynamic. Copy it down and let me know once you're done so that I will then show you again. We will do the quick revision of how to remember the formula. This is just for your reference. This is just for verification that how, if I manually plot in the income statement, I'll get the same answer. In real life, if you have the operating financial and total leverage, you just need to see what is going to be the change in operating profit or revenue, and then you can directly find the change in earnings. Most of the investors are interested, or analysts are interested in this. If they know the total leverages of two companies are different, then the change in revenue, the change in business will impact both of them separately. Clear? Any questions, any doubts till this point?
Percentage changes वाले formula.
I can't hear you.
Percentage changes वाले formula are quite difficult to remember.
What is difficult? Percentages. It's just the opposite, the dynamic. It's just the opposite of static formula. I'll revise it, don't worry. Let me know, guys, everyone is done with copying or solving it. Done, everyone? Anyone still doing it?
ये लिखना है पूरा.
No, just for your reference. You don't have to write this. This is just for your verification.
Done, sir.
In exam, they'll just ask you the change in, they'll give you the change in either of the thing, and you'll have to find the change in the rest thing. So, okay, now because the formula may sound a bit weird here, first of all, focus on what is leverage. Leverage is risk, and risk in business is due to fixed financing cost and fixed operating cost. Clear?
Yes.
The risk due to fixed operating cost is what we call as degree of operating leverage, and the risk due to fixed financing cost is what we call as degree of
Financial leverage.
So just focus on the operating leverage that is due to the fixed cost, the fixed operating cost. So how do I know the formula? So between two companies, even if the contribution is same, see, now understand the logic behind formula. Between two companies, even if the contribution is same, just because one company has more fixed cost and another company has less fixed cost, their operating income will be different. Are you getting it?
Yes.
So I will have to compare that. So therefore I see contribution divided by the operating income, because in between that comes the fixed cost. So contribution divided by EBIT will be my degree of operating leverage. And by the way, the EBIT is changing due to the change in fixed cost. So what is going to be constant? The contribution. The contribution, let's say, is constant for both companies, but the EBIT will change for both the companies. So when I see the dynamic formula, I see the percentage change in EBIT divided by the percentage change in contribution. So both the companies may have the same change in contribution, but their EBIT will change due to the fixed cost. So the technique to remember from static to dynamic is just inverse it. Just inverse it. So degree of operating leverage is contribution over EBIT, and the dynamic is percentage change in EBIT over contribution. Clear? Why? Because degree of operating leverage gives you an answer in times or in ratio. But degree of the dynamic formula, the static formula gives you in times, the dynamic formula gives you the answer in percentage. So therefore we just inverse it. Clear? In the same way, degree of financial leverage is due to the fixed financing cost, that is interest. So between two companies, even if the operating profit is same, if one company has debt and if another company has no debt, then their EBT will be different. So EBIT over EBT, I'll get to know the difference between both companies' financial leverage. And the inverse of it, that is change in EBT over the change in EBIT, will be my dynamic formula. Now, if there is no tax or if there is no assumption of tax, then the EBT or net income or EPS is one in the same thing. So they can use anything. Instead of EBT, they can say EPS also. Clear? And total leverage is always the combination of both. Total leverage is always the combination of operating and financial leverage. So simply you can also add one more thing here for your reference, that degree of total leverage is nothing but degree of operating leverage multiplied with degree of financial leverage. That will give you degree of total leverage. Correct? So in your formula, you can also write it down. Degree of total leverage is nothing but degree of operating leverage multiplied with the financial leverage. Clear, everyone? The conclusion is that the more and more leverage you have, the more will be the risk of your company. Clear? So if markets perform better, having leverage was good or bad?
Good.
It will help you. But if the markets do bad, then having leverage is going to backfire. Higher risk, higher return. Is that clear? Everyone?
Yes, sir.
Yes. Any questions,
Yes.
any doubts till this point? So till now, I have just shown you what happens due to leverage. But what do you think is the conclusion about leverage? What is your opinion? Because, from childhood, we are always taught that don't take risk, don't take debt. But think like an equity shareholder. Is leverage good or bad? Now, of course, the common answer is that it is bad, or it is good, or it depends. But tell me one thing, under which case do you think, if you are an equity shareholder, under which case do you think that having leverage is good for you? If you are an equity shareholder, how it is good for you?
You know,
There is no risk, like compared to what the risk, as in like compared to the debt, like.
No, I'm saying if you are an equity shareholder and if a company is taking leverage, if a company,
Okay, it's the other way. Okay.
no, not the other way. You are see, every company will have some equity, right? It may or may not have debt, but they will have some equity. So let's forget about fixed cost, fixed operating cost. Let's focus only on fixed financing cost. So whether to have debt in your company or debt, I mean, how do you people raise capital from debt and equity, correct?
Yes.
Now it is a choice of the company or the promoter that they want debt or they don't want debt. But if they are taking debt, they already have equity. If they are taking debt, they are increasing the financial leverage.
yes.
Yes.
Is it going to help to the promoters? Is it going to help to the equity shareholders? If yes, under what condition? If no, why? My question to the class is that having financial leverage or increasing debt in my company, how is that going to help the equity shareholders, or how is that going to be bad for the equity shareholders? Please tell me. And this is something that we should discuss in the class. This is what you're doing CFA for. You're going to be the decision makers after being CFA.
Because before equity, the money will be paid to the debt holders.
So I didn't get, what is your answer? Is it good for the equity shareholders having leverage or bad?
Bad.
Okay. Fine. Any other answer that I may have? Any conflicting? Anyone?
Leverages are kind of, we can use it for our purpose when the markets are kind of booming, so we can make more return of it. But if the situation is kind of like, let's say the markets are settling down or there is a correction period, so it's like a negative impact for us, because
Okay.
the amount, the percentage change in the equity will be like higher than the percentage change in the market.
Okay. So what you are trying to tell, I'll just summarize that if the markets are performing good, then having debt is not going to hurt you. Why? Because remember, for the debt holders, you just have to pay fixed returns.
Yes.
You don't have to pay more. But if the markets are
Keep the,
performing bad, then this is going to backfire. Clear?
yes.
So an equity shareholder is interested in net income. That is his earnings, correct? What is eventually he's going to get or she's going to get after paying off everyone, correct?
Yes.
And what is the ratio that the equity shareholder is interested in? Which ratio does the equity shareholder specifically look?
EPS.
EPS is basically the amount that he will be looking. Ratio.
Debt equity.
Return on equity.
Return on equity. Return on equity means how much returns eventually she's getting on her investments, on her equity investment, that is ROE, correct? ROCE, return on capital employed, is for all. Return on equity is for equity shareholders, isn't it?
Yes, sir.
So two things are going to be the focus of equity shareholder, the net income and the ROE. So guys, if your net income and ROE is increasing, it's good for you. If not, then that's bad for you. But how financial leverage, which means how debt impacts ROE, that's what we are going to see, right? So we are now going to understand the effects of financial leverage on these two interesting things that the shareholders are focusing on, net income and ROE. Everyone with?
Yes, sir.
Let's see that. And here I will need your help. Okay. So assume that KRD company has 500,000 in assets that are financed with 100% equity. 100% equity. Fixed costs are 120,000. KRD is expected to sell 100,000 units. Its selling price per unit and variable cost per unit are 4 and 2 respectively. Its tax rate is 40%. Calculate KRD's net income and ROE if the EBIT increases or decreases by 10%. So before it increases and decreases, can you tell me what will be the EBIT? Everyone? What is the amount before EBIT, by the way? In our income statement, what do you have amount before EBIT?
Fixed cost.
Before EBIT,
Fixed cost.
you have fixed cost. Have they mentioned that there is a change in fixed operating cost here? Any change in fixed operating cost here?
No.
No. So the conclusion is that EBIT is constant. So EBIT is going to be the constant. Only the change in EBIT, and we will see what happens when the EBIT increases or decreases by 10%. They have not mentioned anything about the fixed cost. So guys, can you calculate and tell me what is going to be the EBIT? Just put up all the figures. 500,000 in assets that are financed with 100% equity. Fixed costs are 120,000. Selling price is 4, 2. And the total units that they have sold, they have given us tax rate is 40%. EBIT increases by 10%, by 10% up and down. You have 100,000 units. So what is going to be the contribution? 4 minus 2 into 100,000. That is 200,000 contribution. 200,000 will be your contribution, not revenue. 4 minus 2. Fixed cost. And 200,000 minus 120,000, 80,000. Very good. 80,000 will be your fixed cost, will be your operating profit. Is that clear, everyone? How did I get that? 4 minus 2, that is going to be my contribution into 100,000. $200,000 is going to be my contribution. Less fixed cost of 120,000. My EBIT will be 80,000. How about interest? What is going to be the interest here?
No interest.
Zero.
Zero.
There is no debt. My tax rate, they've said, is 40%. So 40% on 8, that is 32,000. So 60% will be my net income, that is 48,000. The number of shares, have they told me how much is the shareholder? So no, I have to find net income and shareholders equity for ROE. So my net income is 48,000. My shareholders equity, what is shareholders equity?
100% asset.
Equity value.
5 lakhs.
500,000 is total assets, which are 100% financed with equity, everyone.
Yes.
Correct? So on 500,000, you have made net income of 48,000. Everyone clear? So your shareholders equity will also be 500,000. Let me know what is your ROE.
And 9.6%.
9.6%. Correct. And what if now we do a minor change here? What if now we do a minor change here? Is that we increase or decrease the EBIT by 10%. So if we decrease the EBIT by 10%, 10%, it's going to be 72,000. 0. And when I increase by 10%, it will be 88,000. Correct? So here it will be 72,000, 88,000. Since there is no interest rate, let me know the tax component. 72 into 40%,
28,800.
28,800, and this will be
35,200.
35,200. Here it will be 88 into 40%.
This will be 35,200.
Okay, this is 35,200 tax you are saying, right?
And the net income in EBIT falls by 10% will be 43,200.
Yeah, so here it will be 72,000 minus the tax.
43,200.
43,200.
43,200. There it will be
52,800.
52,800. Correct. 52,800. Okay, guys. Now, before you calculate ROE here, what is the current ROE? 9.6.
9.6.
How much did I change the EBIT by 10%? So, guys, quickly do 9.6. Add 10% to this, which means multiply 9.6 with 1.1.
10.5.
You'll have 10.56. And verify that 52,800 divided by 500,000 will be 10.56. Correct?
Yes, sir.
And the same from 9.6, deduct 10%. So do 9.6 times 0.9. You have 8.64. Are you getting 8.64? 43,200 divided by 500,000. Everyone?
Yes, sir.
So can someone tell me what has happened here? When there was no leverage, what happened? Very interesting thing you have to observe. There was no leverage. So what happened when I changed the EBIT? How did it impact your ROE or net income?
Directly, what beta of 1, sir.
Okay,
Positive 1.
correct. So what is he trying to say is that the change in EBIT and the change in ROE is same. The ROE also fluctuates by the same rate because there is no leverage. So if the operating profits change by 10%, my ROE will also change by 10%, isn't it? Everyone?
Yes.
It changes by the same rate because there is no financial leverage here. Are you getting it, everyone?
Yes, sir.
Yes.
Everyone is observing this. It's not about mathematics here, okay? What is the conclusion here? That since there is no financial leverage means debt. There is no debt. If there is no financial leverage, then change in EBIT and change in earnings or ROE is same. Ratio is 1, correct? So here, if you see, because I changed the EBIT by 10%, my EPS also changed by 10%. Exact same change. No impact of leverage, you can say. Clear? But what if now I take the same scenario, the same structure, but the capital structure I will change. Instead of 100% equity, what if that 500,000 is financed with 50% equity and 50% debt? Then what will be my shareholders' equity here? Can I say it will be half? Everyone? Because where is the other half coming from? Not from equity, it is coming from debt. correct? What was the EBIT, guys? EBIT was 80,000 and we changed it by 10%, right? So here we put 72,000. But now I will have interest, isn't it? How much is the interest? Guys, let's see that. 50% debt. The interest is 6%. 6% is the interest, guys. Can you tell me how much is 6% on 50%? 50% of 500,000, which means 250,000. 250,000 into 6%. Can you tell me how much is the interest?
15,000.
250,000 into 6%. You'll have interest of
15,000.
That's gonna be your interest. Correct. Due to this, your amount will now change. So 72 minus 15,000, this will be 57,000. This will be 65,000. This will be 73,000. Am I correct? Subtract tax rate 40%. To 800. So this will be 33,000. Sorry. 57, 18,100. Sorry. How much is it? 57 and tax rate is 40%. So 57 into 0.6. I get 34,200. Am I correct? Same way, I will do 65 into 0.4 is going to be my tax rate. That is 26,000. So remaining 39,000 will be my. Guys, y'all are not giving me the numbers. 73 into 0.4. My tax is going to be 29,200. Let me know if I'm correct.
43,800.
And 73 into 0.6. 43,800.
800.
Correct. Now, just see what happens to your ROE. So just put 39 divided by 250,000 first. Let me know the answers.
15.6%.
15.60. That's your ROE. What has happened to your ROE? Increased or decreased from the previous point?
Increased.
Increased substantially. But if the EBIT is changing, what happens to your ROE? Just see that. See in the previous case, because there was no financial leverage, how much was the change? The change was similar to EBIT.
Yes.
It changed by just 10%. Now just see, is the change going to be same by 10% or more? Let's see, 34,200 divided by 250,000.
13.68.
13.68. Let me see, 13.68 divided by 15.6. 1,200. So the change here is around 12.3%. It is more than 10. The change from this point to this point, so from 15.6 to 13.68 is not 10. It is more than 10. And the same way you will see above. So 43,800 divided by 250,000, you'll have 17.52. Am I correct?
Yes.
And this is certainly greater than 10%. So if you take 17.52 divided by 0.56, it is 12.3. Instead of 10%, it is 12.3 up and down. 12.3. So instead of 10%, guys, how much is your change here? Instead of 10%.
12%.
To be precise, I think it's 12 point. what is the change? I think the exact change is 12.307 or 12.31 percentage. 12.30 percentage change, upside and downside. And how much was the change before?
10%.
10.
10 percentage here, and on the other side the change was 10 percentage, correct? Now, first of all, can you tell me what was the financial leverage in the first point when there was no debt? How much is the financial leverage when there is no debt?
1.
1.
1. How did you calculate 80 divided by 80? You got 1. And then if I see the change in my net income or ROE, therefore I will write percentage change in net income or ROE. Can I say it will be 1 into change in EBIT, which is 10 percentage, isn't it? Correct?
Yes.
But here, can you tell me what is the financial leverage here? Degree of financial leverage. 80 divided by 65. What is 80 divided by 65? You'll get 1.23.
2, 3.
2, 3.
Isn't it?
Yes.
Correct. And then if you find percentage change in net income or ROE, it is going to be 1.23 into we change the EBIT by 10 percentage. So you got the outcome as 12.3 percentage. Got it? Everyone? It matches, isn't it? So what is the conclusion that you have drawn here? What have you observed and concluded? That is more important for me than the mathematics here.
That is an important part.
Sorry?
That does plays a main role in the that important.
Leverage magnifies your gains and losses. So if you take leverage, the variability in your EPS, the variability in the return for shareholder increases. The variation increases, right? So the shareholders can get extreme high or extreme less returns if they employ more and more financial leverage. Is that clear, everyone?
Sure.
So not only the amount changes, but the not only there is a difference in amount, but there is also a difference in the change, percentage change rate. So what has happened because of leverage? ROE is higher using leverage. And leverage also increases the rate of change in ROE. So the ROE changes substantially upside and downside. The variability increases. Why? Because ROE varies directly with the change in EBIT. If the EBIT changes, ROE also changes when there is no leverage. The change is exact, correct? But when you applied leverage, the ROE changed more than the change in EBIT, isn't it?
Yes.
Correct. So when we did not apply the leverage, the change in EBIT and ROE was same 10%. But when we did apply leverage, ROE became more volatile. ROE changed more. Correct. So basically what happens because of financial leverage, the more and more debt you have, the more and more financial leverage you have in your business, your ROE or net income becomes more and more volatile. So you have scope of higher returns or higher loss. The risk increases. Why the risk increases? Because you have to pay through the debt. If you are not able to pay the debt, the default chances increases. So overall risk and return both will increase if you have financial leverage. Are you getting it? So conclusion, if you are sure that you're going to make enough profits, if you are in the line of business where you think that you will at least get enough profits to repay your debt, then you should take debt. You're getting my point? So let's say if the cost of debt in our country is, let's say 10%, example, ideally it is 16-17%, which is very high in an emerging, not surprising, but it's very high. So let's assume that the cost of debt is 10%. Okay. And if you are in a business where you think you can make 15-17%, should you take debt or not? You should definitely take debt, because if you take debt, then the ROE will increase. Got my point? But if you are not sure of covering the cost of debt, then you should not take leverage. But if you are, then you should definitely take. If you're not taking, you're doing a wrong business. So leverage you should take. You're getting my point? Clear? So do you notice, do you remember what is the, what I asked you at the beginning of the session? Where do you get this word called lever and gear from?
Cars.
From cars, right? Remember that? Deepthi, Divyesh, everyone.
Yes, sir.
Yes.
Right? So what did I say? That speed, that lever and gear is used to increase the speed in the car. So tell me honestly, when you learned driving for the first time, did you directly start with the fourth gear or the fifth gear?
Reverse, sir.
Which gear? Reverse gear. What do you start with? The first gear, right? You start with the first gear. And then when do you switch to the second gear? Anyone? Think of your driving time.
Once you
I-
cross 20.
I remember that probably for the first 10-15 days, I was only driving at the first gear. I never had the, never had the guts to go to the second gear. I was very scared initially. And, but if you're driving on the first gear only, especially if you're in a traffic and all, but as I said, these days you have automatic gear, so you don't have to worry about that. But assuming you have a car with gear, you're driving on the first gear only. When do you switch to the second gear? Two things. When the car takes speed, correct? Then you have to switch to the second gear. If you don't switch to the second gear, what happens? Come on, tell me, everyone has driven car.
Engine chokes up, sir.
Do you notice some sound or the engine sound? If you're just on the first gear and the car is taking the speed, it will push you to go to the second gear, right?
Yes.
And if you don't do it on the second gear, the car loses efficiency. So once you're comfortable with the road, once you're comfortable with the speed, once you're comfortable with the control, you should move to the second, then the third, then the fourth. So gradually, based on the speed, the road, and the control, you should move the gears. You should move the lever. That's how you should do in the business with respect to debt. Initially, no one takes directly huge debt. They first start with the smaller debt. Once they become comfortable with that, comfortable like driving the car, controlling it, they're able to repay the debt. The road should be good. The market conditions should be good. Try to relate that, okay? Once it is good, then the market is smooth, the markets are performing, then you should jump to the second level. You should start increasing the debt. Only then you grow. But those people who tell me that, no, I'm comfortable without debt, these guys are driving the car at first gear. They will never grow. They will rather lose the efficiency, because when markets are good, when the road is smooth, and when you can control it, you should switch the car to second and third and fourth gear. Are you getting my point, everyone? So leverage is not taboo. Leverage is not bad. Leverage is that car gear system. You have to take the car to the first, second, third, and fourth, but in stages. You can't directly jump from first to fourth gear. Your car will suddenly, wobble and just collapse. Getting my point, everyone? That's how leverage is very much related to the car, how you drive a car. And that's how you should drive the car of your business also. And the leverage, the fuel here is debt. Got it? Everyone?
Yes, sir.
Yes.
So fixed cost and fixed operating and fixed financing cost. When you start business, what is your first goal? Your first goal is that I should sell enough quantity to cover my costs, isn't it? You will have that in mind. For example, if I have taken huge class and my fixed cost is, let's say, 50,000, and if I charge every student $1,000, I know that I need at least 50 students to cover my cost. Correct?
Yes.
So now we are going to find the break-even quantity of sales to cover your fixed operating and financing costs. That is called break-even point. And when I just want to cover the operating costs, then we say operating break-even point. So what is break-even point? Break-even point will give you the quantity that you need to sell to cover your
Fixed cost.
fixed and
Variable.
fixed operating cost and
Fixed
interest, financing cost. But when you just want to cover the operating cost, then we call as operating break-even point. So we will just take how much quantity I need to sell to cover the fixed cost, fixed operating cost. That's it, not the interest. So the formula here for quantity break-even quantity for covering your fixed operating cost and interest is fixed cost plus interest divided by contribution per unit. P is price of the units being sold and V is the variable cost. So P minus V is called contribution margin, contribution per unit. That will tell you how many units you need to sell to make it break even. Clear? Let me show you this. So here you have 60,000 units produced and sold. You have the sales and variable cost. So first of all, we will find out what is the break-even point and then operating break-even point. So for company A, how much is the fixed cost and fixed financing cost, guys?
1,80,000.
120,000 and 60,000. That is 180,000. So I will take 180,000, guys, divide by the contribution per unit, which is 8 minus 2. That is 6. That means I'll have to sell 3,000 quantity of A to cover my cost. Is that clear, everyone?
Yes.
How much just to cover the operating cost? Will I have to sell more or less?
Less.
Less, because I have to cover not all costs. So 120,000 divided by the contribution, it will tell me that I have to sell 2,000 quantities. So just let's verify this. What is the total revenue I will put for A? 60,000 into 8. So that will be 480,000. Am I correct? Variable cost will be 60,000 into 2. That will be 120,000. But that is if I take the total quantity. To find the break even, what will I do, guys? How many units I need to sell? 3,000.
So that's 30,000.
No, sorry. Is it 30,000? My mistake. 180,000, right? Sorry. 180 and 120,000. Correct. So 30,000 here and 20,000. Sorry. Everyone. So how many units I need to sell to do the break even? 30,000.
30,000.
Let's do 30,000 into 8. That is 240,000. Variable cost will be 30,000 into 2. That is 60,000. So my contribution will be
Like
30,000 into 6, 180,000, correct? Now my fixed operating cost is 120,000. So I will be left with 60,000. And that's what my interest cost is. So basically at this point, my interest cost is also 60,000. My amount of EBT will be 0 in this case. They have not given me tax or anything. So I'll just simply erase all this thing. So guys, at this point, I can say my EBT is 0. It's at break even. So I will at least have to sell 3,000 quantities to cover my cost. Any quantity above that will be beneficial for me, will be adding profits to me. Clear, everyone?
yes, sir.
Can you do that for B, everyone? And before calculating for B, can you tell me that will B be more riskier or less riskier? Will B, you will have to sell more quantity or less quantity? Just see B and tell me. Will you be able to tell?
Yes, sir. Less
If
quantity.
not, don't worry, just simply calculate it. Your total cost here is 90 plus 30, that is
1,20,000.
120,000 divide by contribution in this case is 5. So that's
24,000.
24,000. You have to sell less here. 90,000 divided by 5. So 24,000. Eventually it should be 0 here. So 24,000. Just verifying it. This table that I'm drawing it just to verify it. So 24,000 into 8 will be
92,000.
192,000. Then 24 into 3, 72,000 will be my variable cost.
1,20,000.
4 into 5, 120,000. My contribution, my fixed cost is 90,000 here, fixed operating cost. I'll have 30,000 as my operating income, and my interest cost is also 30,000. So that will give me a break even. Is that clear, everyone? So it tells me that for company A, they will have to sell more goods compared to company B in order to break even. Right? If you sell, if your target, if you think that you're going to achieve goods less than this, then probably you'll have to deleverage yourself. Clear, everyone? Any questions, anyone? Yes, anyone, any questions, any doubts? So everyone cleared with break-even point? Break-even point is covering total cost divided by the contribution. And operating break-even covers only fixed operating cost. Clear? It tells you the number of units that you should sell in order to cover your fixed operating cost and financing cost in the break-even, to make it break-even. Is that clear, everyone?
Yes, sir.
So this is just for your verification, not for solving. This is just to display that how it eventually becomes 0. So leverage means risk. If you invest in a company, investing in debt is more riskier or equity is more riskier in a company?
Equity.
Everyone? What is more riskier when it comes to investment in a company? Investing in its debt or investing in its equity?
Equity.
Equity?
Equity.
Why? Because equity gets paid after the debt owners. So debt owners, what is the risk to the debt holders? First of all, they have a priority of claim before the equity. So when it comes to assets, they have a claim. When the company is liquidating, they have a preference. Their value is paid first. When the company is making profits, interest is paid first before paying out the dividends. Everyone clear? So in that way, investing in debt is relatively better than investing in equity. But equity owners, because they are being paid the remaining amount, that is the whatever is left, which is why we call it the residual amount. So if the company makes more profits, everything else which is left after paying off to the debt, everything belongs to them. So they are taking the calculated risk and they are aware about it, and therefore they are expecting more and more to be left out with the company. Also, one more thing that they get compared to the debt holder is that they get the voting rights. Do debt holders have voting rights or equity holders have voting rights?
Equity holders.
Who has the voting rights? Everyone.
Equity holders.
Equity holders. So they have the day-to-day decisions in their hand. They can hire or fire anyone in the company. They can be because they are the stakeholders, they are the shareholders basically. Stakeholders are everyone. So they are the shareholders, they have the decision-making power with them. Clear? In fact, how much to take the debt, how much to have the fixed operating cost, how much to have the fixed financing cost, that decision lies with the equity shareholders, not with the debt. The debt shareholders does not have the decision that what should be the company's capital structure, how much equity should the company raise. But the equity shareholders do have that power. They have the power, they have the flexibility to change the capital structure. Clear? Right, everyone? However, the problem is that when the companies are financially leveraged, highly financially leveraged, and if they are not able to repay the debt holders may force the company to become bankrupt. The company will become bankrupt. And the company here is smart also that, first of all, bankruptcy, does it mean that once you go into the bankruptcy, the company is finished? The company will never come up? Well, ideally, we assume that once someone becomes bankrupt, that means he's on the street. He's begging on the street. Is that the case in real life with the company or with an individual? No. When you declare bankruptcy, which type of bankruptcy have you declared? That is very important. So there are these laws which helps you from the clutches of your debt holders. So companies with high financial leverage use this bankruptcy and protection laws to change their capital structure once the restructuring is complete so that they can emerge back. So what happens that companies, when they feel that they are unable to pay the debt, especially in US and the Western world, they declare bankruptcy. Once they declare bankruptcy, they show their inability to repay. Then as per the bankruptcy law, you will have to reorganize the company, restructure your debt, negotiate with the lenders, or liquidate the company and shut down and repay everyone. That depends on which type of bankruptcy you are filing. There are various bankruptcy related chapters in US. The most famous is chapter 7 and chapter 11. Chapter 7 is liquidation bankruptcy. What is liquidation bankruptcy? When a business is unviable, what will the creditors do? They will tell the company to shut down. They will liquidate all the assets. And try to pay off all the lenders. Clear? So tell me one thing. If the company files for chapter 7, that is liquidation bankruptcy, does the company have the chance to again turn up?
No.
No, it is virtually dead. Everything is being sold off. The company is distributed in parts, assets are sold off and paid to the lenders. Everyone clear with chapter 7 bankruptcy, which is called liquidation bankruptcy? Yes or no, everyone? So under liquidation bankruptcy, all the assets are sold off and whatever is the debt which is outstanding is turned bad, which means the company will not be able to pay back. Now, this chapter 7 bankruptcy in US can be filed by an individual as well as by the business. But once you file chapter 7 bankruptcy, game over. Is that clear, everyone? Yes?
Yes.
There is another bankruptcy which is called chapter 11 bankruptcy, which is called reorganization bankruptcy. Reorganization bankruptcy is very, very, very common. Reorganization means you temporarily get protection from the creditors by reorganizing or restructuring the company's capital structure. So the bankruptcy code allows you to reorganize where you can negotiate with the lenders, tell them to let go of some of the debt or the interest outstanding. The shareholders may have to contribute more or they'll have to let go of their stake, but the company survives. So there are lots of losses which are written off. Many small, the creditors may not get their full amount. A lot of amount has to be written off, which is what we call as the lenders will have to take a haircut. What do you mean by haircut? In the banking term, a haircut means that lenders will have to let go some money. But the company does not stop here. The company does not stop as a going concern. The company will continue to work and operate under the revised structure. This is called chapter 11 bankruptcy, which is called reorganization bankruptcy. Everyone clear with me? Here the assets are not sold, but they are restructured. And is the debt completely wiped off? No. Once the business is going concern, in the future, whatever the business makes money, Of that, the previous debt will be repaid. Is that clear, everyone? Yes or no?
Yes.
This Chapter 11 bankruptcy is allowed to be filed in US only by companies, not by individual. So tell me one thing, which bankruptcy do you think should be very common with companies, and companies can smartly use it to pay off the debt? Which
11.
bankruptcy? Chapter 7 or 11?
Chapter 11.
Chapter 11. Before Tesla, the world's largest company in cars, the car making company, General Motors, have filed bankruptcy in the past, especially during the subprime crisis. General Motors, Chrysler, they have filed bankruptcy in the 2008-9 crisis. In fact, Marvel Entertainment, which is Avengers and Spider-Man, right? Can you believe that that company had filed bankruptcy in 1996 and today it's $1 billion company? So these companies, they had filed bankruptcy and they came back. Why? Because they must have filed which bankruptcy?
Chapter 11.
Chapter 11. In fact, if you have had the pizza from Sparrow, they had also filed bankruptcy twice in 2011 and 14, and then they reorganized and came back. Correct? But then there are companies like Enron, which was oil and gas company, which was entangled in the fraud. Same like WorldCom, which was a telecom company, US, the largest fraud in the US history till date, and Lehman Brothers. These companies never came back because they filed for Chapter 7.
7.
Clear. So bankruptcy is not a taboo. Many companies deliberately do that so that they get a haircut. They get a discount in the debt, and then they reorganize and come back. Okay. So that's the reality these days of, giving credit to companies. Got my point? So what initially people used to think that debt is more safer. Well, these days debt is not safer, and companies do take the advantage of these laws of bankruptcy, and it's very common in US to file bankruptcy and then reorganize and come up. That's good for the company survives, but the debt holders faced almost the same risk as equity shareholders. Clear, everyone? In fact, do you remember that? I don't know whether you are aware or not, but Apple was actually on the verge of bankruptcy in 1999. Can you believe that? And who was Steve Jobs' most closest competitor, the biggest rival? Bill Gates, Microsoft. So Steve Jobs actually called up Bill Gates. And what did he say? That we have been fighting all along we have been competing with each other. My company is on the verge of bankruptcy. Will you invest in my company? Just can you believe that? If you are at the Bill Gates shoe, what will you think? That my competitor is dying, his business is finishing. That's going to be advantageous to the Bill Gates, right? Through the Microsoft, isn't it?
Yes.
Everyone?
Yes, sir.
So what did Steve Jobs did? He actually called up Bill Gates and said that bail out my company. So instead of, just letting the company die and become bankrupt, Bill Gates actually went out and bailed out Apple, and see where Apple is today. So do you think Bill Gates did a mistake by bailing out Apple? He invested actually in the company and also sold the shares after a few years. I think after 1 or 2 years, they sold all the shares. So Microsoft does not have or Bill Gates does not have the Apple shares now. Just imagine if they had Apple shares now, where would they be? But they sold off the shares. So first thing that they actually bailed out Apple. So today where Apple is and competing Microsoft, one of the biggest reason is because of Microsoft bailing them out. So what do you think? Was that a wise decision by Bill Gates or mistake, or what happened? And how did Steve Jobs convince his rival to invest in his company? Any idea, anyone?
So the idea of bailing out the Apple was at the time lucrative for Bill Gates because I'm sure he must have made millions from it.
So if it was lucrative, then he should have held it up, right? He sold it immediately.
Yes.
What do you think? Others? Any idea? In US, there is a law called anti-competition law or anti-monopoly law, which says that if the company becomes too much dominating, then the regulators will split the company. They have done in the past with ExxonMobil. It became one of the largest oil companies in the world and the largest in US. So the anti-competition law there, the competition law, which is the anti-monopoly law, basically, they force the company and split the company. I think because of that, now you have ExxonMobil, Chevron, and Shell, many oil companies instead of one giant oil company. So Steve Jobs actually called up Bill Gates and said that he may have used it in a different way, but I'm just making it more dramatic here. He called up and said that instead of having no competitor, if I die, or I mean, if my company dies, then you'll be left with no competitor and you'll be the dominant, you'll be the monopolist. And then the regulators will split your company. Are you getting it? That's what Steve Jobs communicated to Bill Gates. So Bill Gates thought that it's better to have a weak competitor than no competitor. Got my point, everyone?
Yes.
So he said that instead of having no competitor and the regulator splitting my company, it is better I have a weak competitor. So then they bailed out Apple at that time. So that was their, I can say, constraint. They had no choice, but they had to bail out the competitors. Otherwise, they would become the monopoly and the regulators would have split Microsoft, which Bill Gates never wanted to happen. So that was the reason that the world's largest two competing giants bailed out, the Apple was being bailed out by Microsoft. And then they sold the shares after 1 year when Apple was, recovering.
Why did that sold off, sir?
Because that was not a strategic investment for them. That was only, they didn't want it to be investors in Apple for long. And also remember that, they didn't want it to control Apple. They probably did not have envisioned Apple as lucrative. They thought that it's better we invest more in our company. And you know what, right now you feel that, whoa, why did they miss Apple? But at that time you didn't knew that Apple would come up with the world's biggest revolution called iPhone and iPad and Mac and everything. Okay. So in 1999, no one imagined Apple would come up with something which will change the way we live. That is smartphones. So that was the time. Got it?
Yes, sir.
No one knew at that time this would be the hot cake, because Steve Jobs had the history of being thrown out from his own company because of his temper and decision-making issues. So maybe Bill Gates didn't believe too much into him at that point. No one knew about him too much unless and until he came with a very unconventional way of launching up smartphones.
Smartphone.
Got it? I mean, he's changed so many things. Before that, people used to go in suits and present it. He started presenting. I mean, I remember seeing one of his presentation for that Macintosh where he did the investor presentation where he was in shorts. And that is, I'm talking around 1980s somewhere. So he went out in the presentation and in the entire auditorium, he was in shorts and he was doing the presentation, Steve Jobs. So that's how he was. He changed the traditional way. And these people are called crazy, arrogant, rude until they become successful. Once they become successful, they're just successful and legend. So many may not know, but Steve Jobs was known for his anger issues in a room full of meeting. What would you do if someone, gives a counter opinion, or if someone suggests some changes, or let's say you have a team of all the management, and someone tells you that no, instead of doing this, we should do this, right? How would you behave in that way? In that meeting, let's say you are putting up some point and someone raises a doubt that no, instead of this, sir, why don't we do this, because this I think will not work. What will be your reaction in a board meeting or in a management meeting? How would you react, even if you are owner of the company, and if your employees or if your management or senior management may not argue, but they may have a counter opinion? What would you do in such a case?
Listen to them.
Listen to them, right? Would you like to listen to them, by the way?
They just listen from one ear and take it out from another.
Okay. Steve Jobs used to fire them, by the way. He used to say, get out. If you don't believe in my concept, get out. That's what he used to do. He was very well known for firing at his staff members, at his secretaries and all. He was very, what I have read, he was very arrogant and rude. But because he was too much focused on what he wanted to create, so everything else didn't matter. And when people are so obsessed with so much of perfection, if they find one thing here and there, they don't adjust, they don't compromise. That's what Steve Jobs was. I think because once you're creating something so historic, people may forget what other mistakes you must have done. Okay, that's how it is. And by the way, Steve Jobs got he was also stuck in life like us, as to what should we do in life and how should we take it forward. So do you know where did he went to basically get this feeling of what he wanted to in life? Where did he went and concentrated and meditated, and then he realized that this is what I have to do?
He came to India, I guess.
He came to India, and that in Rishikesh.
Oh, wow.
It is said that it is written in his autobiography as well, that his turning point in life was when he came to India, that is Rishikesh. So that's where he went to one Baba. His name was Neem Karoli Baba, the Godman. And he says in his biography also that changed his life. And when Mark Zuckerberg went to Steve Jobs to just take an advice that, I'm the growing entrepreneur, what should I do and all. So Steve Jobs advised him, go to India once. And even Mark Zuckerberg had come to India. So many legends have traveled to India, explored India before they do something great. So if you get a chance, go to Rishikesh, roam around there. Probably you may also get a vibe which is very different, and you may come something very creative. I did the same. Just before starting this batch, I went to Rishikesh. Now let me see how creative this turns out to be. Okay. I was inspired by Steve Jobs and Zuckerberg. So I thought that even I should go to Rishikesh. So I just went to Rishikesh before this batch. I hope it turns out to be creative and interesting. Not as good as them, but I was a bit inspired. But that place is amazing. If you get time, do visit that place. Amazing. It has a different vibe. Okay. Once I went there and I came, I realized definitely this is the place that no wonder the world's legends have come to this place. It has a different vibe there, a different positivity. Okay.
Yes, sir.
Okay. That's the end of leverage. So we are done with leverage, and now we'll begin with the next topic. Okay.